You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Well, markets not doing so great lately, to say the least. And is it time to book? Is it time to get out? And is it time to basically head for the exits? Well, we've got with us Anthony Saccaro. Anthony is a attorney like myself, and also a financial expert and president, founder of Providence Financial and Insurance Services. So, Anthony, is it time to vacate the market and put your hard-earned profits in a safer place?
Yeah, that's the question that everybody wants to know, right? The reality is that it's going to depend on the phase of life that you're in and exactly what you're doing at this point. If you're 30s, 40s, maybe 50s, and you have 20 years plus until retirement, I say you stay the course. You keep dollar cost averaging, you keep putting into your 401k, your retirement plans, you keep buying. If the market drops and your dollar cost averaging, it actually helps you. Volatility is your friend when you're putting money in. However, if you're at the phase of life where you're within, say, 4 or 5 years of retirement, maybe even 10 years of retirement, Kerry, then the bottom line is it's probably time to start thinking about taking some of your chips off the table. 2021 was a great year. 2020 was a great year after the rebound of the COVID was a good year. 2022, not so much. If you're within 5 years of retirement and you're really hoping that the market does well so that you can retire, I think that's a gamble. I think that's a game that you don't want to play. And I think we're at the point within the next year or two, there could be a recession. And I don't want you to get caught in that recession and not be able to retire because of the fact that you were not invested properly. So I wouldn't say it's time to head for the doors just yet, but I think you need to be cautious depending on where you are.
Okay. So you know what John Maynard Keynes used to say, that in the long run, we're all dead.
That's right.
Right. So why worry? But let's be realistic here. If you're in the market now, you're nervous, but we've got this inflation going. You don't have a lot of alternatives to put your money. If you put it under the mattress, you're going to lose a fortune, right?
Yeah, you're exactly correct. And then that's one of the things that I deal with on my radio show a lot, on my podcast a lot, people calling in and asking, what do I do with my money? And when you look at the three asset classes, Kerry, it all boils down to stocks, bonds, and cash. And stocks right now at almost record highs, and I think we're only 5 or 6% off of record highs at this point. With the recession looming potentially, the fact is it's not a place that if you've got a bunch of cash, I think it's time to enter the stock market at this point. So that's not a great place right now. Bonds are not a great place, especially bond mutual funds, because interest rates are going up, and so the fact is that bonds, are going to have that as a headwind against them. So that's not a great place to put your money right now. Even individual, high rated corporate bonds are probably only 3%, 3.5%. So not going to keep pace with inflation. So that's not a great place to put your money. And of course, cash is not a great place either because you're not earning anything in the bank. So the question is, where do you put it? And I think the answer is to put it in something that's going to pay income. If you're in the growth stage of life, you can put it in dividend stock. If you're in the distribution phase of life and retirement, then you probably want to focus on investing in things that are going to give you income. Income is the bird in the hand. That's the guarantee. And if you can invest in the stock portfolio and generate 3-4% in dividends like our clients are doing, you can count on that so that no matter what happens with the market over the next decade, at least you can count on your dividends. And right now the dividends are putting the bank interest to shame.
All right. So cash flow is king, but arguably inflation is raging much higher than the 8.5% that the government admits to. So you've got to get a major return in order just to stand still, right?
Well, you do, and that's exactly right. And then the question is, can you afford to take that risk? And if inflation truly is at 8.5%, as the government has admitted to, well, there's nothing out there that's going to give you a consistent 8.5% dividend or yield without a lot of risk. But we have to remember, too, that there's such a thing as personal inflation rate. And this is something that's not talked about a lot. But if you don't drive, then you don't care that gas is $6 plus a gallon, at least here in California. And so if you don't travel, you don't care about airfares. And we tend to pay, we pay our bills with money, and we pay our bills with cash, and it's all about cash. It's all about the cash flow. If you have the cash flow to live retirement and live the way you want, then I think this inflationary period is a period that you're just going to have to ride through. There's a lot of people that think inflation is peaking, maybe just be at this level for a couple more months. I hope that's the case. We won't know until a couple months down the road. But you want to be in a position personally to where you're debt free, to where you have the cash flow to be able to do the things you want, regardless of what the national inflation rate is. National inflation rate doesn't affect you personally, which I think is just an important component to inflation. A lot of people don't talk about.
All right. So we've got inflation raging, and it doesn't look to me like it's transitory. If you bought what the Fed was saying, hey, you would have just not done anything because it's transitory. But here we are a year later. And look, I always say, Anthony, that the best things in life are transitory, but this inflation looks like it's here to stay. It looks like, by all accounts, we're in an inflationary cycle. They can go on for decades. We've seen it in the past, 60s, 70s, inflationary, and early 80s, inflationary time period. And really, none of the tried and true ways are really going to save you from that, are they?
Well, that's exactly right. If it is not transitory and if it is here to stay, then you really, really have to focus on your personal situation. I just spoke with a client before we got on this call, and this particular client had the ability to get $40,000 a year of interest and dividends from his portfolio at 4%. That's all he needed. Had $1 million at 4%, could get $40,000 a year. But his lifestyle only required him today, with current inflation rates, to get $20,000 a year out of his portfolio. So in his situation, because he's invested and able to get $40,000 a year from income without ever touching principal, without ever selling a single share, living on 2%, inflation for him is not that big of an issue, because he can double the amount of income he can get from his portfolio and still never have to worry about running out of money or even touching his principal. So I think that's important. It goes back to the personal inflation rate that we talked about. You want to make sure that you set yourself up to where you can live comfortably no matter what the inflation is, off of your Social Security, off of your pension, off your rental income, and off the income that you're getting from your portfolio. So I think that's very important as well, too.
But we're not in normal times here. Look, you and I grew up when you went to buy a new car and you drove it out the showroom, it was worth 25% less. Now it's worth 10, 15% more. Used car prices, although they took a breather last month, have been on a tear to the point where these cars are selling for more now than they did when they were new. So we're not in normal times here. What can you do to really protect yourself?
Don't just survive, thrive. The Financial Survival Network.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near two producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold two companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
Yeah, so I think the reality is you're right. We're not in normal times. And how long this lasts, I think, is going to have a big impact on you. But if you are invested in high quality equities that are paying dividends, I think that gives you your best shot of being able to overcome inflation or at least keep pace with inflation. I think that's your best shot. If the market crashes and you're getting your dividends and your portfolio crashes with it, if you're living off your dividends, you still get the income without selling the share. So a crash doesn't hurt you as long as you're living off the income. If you are in a fortunate enough position to be able to reinvest your dividends and a market crash happens, then guess what? You get to reinvest your dividends while the price of assets is down, which means you get to buy more shares. And in the market, we know that what goes up must come down. And we've had 13 years of good run at this point, almost 15% return in the market. But we also know that the reverse is true. What goes down in the market must come up. So you have to be in a position to be able to win either way. You have to be in a position to where whether the market goes up or down, you're in a position to win. You're in a position to be able to take advantage of that. And it all depends on the phase of life you're in. I wish, Kerry, there was one magical bullet, a silver bullet that's good for everybody, but we know that that's not the case. It depends on the position that you're in as to what your strategy is. But I really do think that it is focused on getting the bird in the hand, focus on that dividend, focus on that interest, because that's what you can count on. You can't count on growth at this stage.
Yeah. So growth stocks, tech, all this great stuff. Maybe one day we'll look back and wonder what all the fuss was about, right? I mean, the cloud companies have just gotten decimated in the past couple of weeks. A lot of companies have been decimated, not necessarily the leading indices, not the FANG stocks. They look like they're doing somewhat okay. But I looked at housing recently, Anthony, and Toll Brothers, Lennar, all of those guys hit their peak in December. And it's one of the ugliest looking charts I've ever seen.
Yeah, that's not a surprise, though, right? Because 30-year mortgage rates, I think, went from 2.5% to 5%, in the last 2-3 weeks or month. I mean, so with the Federal Reserve raising interest rates like they have been affecting mortgage interest rates, that's certainly going to put a kibosh on the housing market. Interestingly enough, it hasn't seemed to have done that yet, but we don't have the numbers at this point. So the reality is that that's certainly going to slow things down. With the Federal Reserve talking about a 50 basis points increase in their next meeting, I think that's going to tame things as well. I don't think inflation is going to be around as long as it could be. But the thing is, I don't want you to put your money in a position to where inflation has to be low. Let's invest for where we are right now. Let's plan on winning no matter what happens in the future. And I think you can do that. But I also think that the Fed's going to put a kibosh on inflation, but that also is not going to be good news for the market. So now you have to be careful if you're overweight in the market as well.
How much of a kibosh can they really put on the market? Because you think they're willing to just drive the stock market and the economy into obliteration?
Oh, I don't think that they're willing to do that. I think it's something that could happen accidentally. Interestingly enough, it hasn't happened yet. And they've been extremely hawkish. It seems like the more hawkish they are, the more the market continues to do okay. So it's a very interesting dynamic at this point. But what I think they're doing, Kerry, is I think they're loading the bullets in the gun. They've been so behind the eight ball for so long. They've spent all their bullets that if we have had another recession, they couldn't do much other than print more money. They couldn't lower interest rates because you can't go below zero. I mean, theoretically you can, but I don't think they're going to go into negative rate territory.
They didn't. They had the opportunity 2-3 years ago. They refused to do it. Actually, that's right. 5 years ago. So that's just not happening. But hey, when you look at all these issues here, how high can the Fed really go? I mean, every time in the past they've tried to raise rates, Anthony, we've seen the market go into a conniption. It seems to be holding up a little steadier now. But we've seen like the economy threaten to collapse. Are they willing to do it? Are they willing to do what's really necessary to control inflation? I think seeing is believing.
Yeah, it's going to be an interesting dynamic, right? That's what we don't know. You're right. Seeing is believing. In the past, when they've, increased interest rates, it has had a negative effect on the market short term. And in the long run, it's actually been positive for the market. But if they get inflation under control, I think that's the biggest deal. And because they've loaded bullets in their gun and they've raised interest rates and are going to continue to raise interest rates without an apparent impact on the market at this point, what that does is that puts them in a position to where if the market does start to spin out of control, they can lower rates again very quickly and tame the market. So I think the number one concern of the market right now is the Federal Reserve's actions. And they've been more hawkish than I thought they could be without sending the market into a tailspin already. So they certainly haven't crossed over that threshold yet. Where that threshold is, I don't know. We'll let you know when we cross it.
All right. I guess we'll know when we get there, but we're not there yet. And it's going to be interesting to see for sure. Anthony, want to find out more about you, connect with you on the web. Just remind us, how do you contact Anthony Saccaro and your company?
Yeah, our website's the best place to do that. And that website is providencefinancialinc.com. Don't forget the INC on the back, providencefinancialinc.com. And there's all the information there about us, our contact info. And if anyone has any follow-up questions, they're welcome to call me. More than happy to talk to them or help them any way I can.
We appreciate that. And if you got a question for Anthony, you can always shoot me an email. I'll get you an answer, kl@kerrylutz.com. And don't forget, sign up for your free newsletter at financialsurvivalnetwork.com. Anthony, always a pleasure. Thank you so much for coming.
Thank you for having me. Great to be with you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.